This program and the associated written materials are provided for informational purposes only and are not intended and must not be taken as legal advice on any particular set of facts or circumstances. You should not act or refrain from acting on the basis of any content included in this program without seeking legal or other professional advice on your specific matter. This program contains general information and may not reflect current legal developments or address your specific situation. This program and the associated written materials are not intended as a solicitation.
I welcome all of you to the Beverly Hills Bar Association's Guide to Tax Issues Following a Natural Disaster. We wish to share our sympathies for all who directly or indirectly are victims of the Eaton and the Paradise fires and express our appreciation to all the first responders. This program is going to focus on tax issues, many of which are likely to change over the next 3 to 6 months as the Congress and the state legislatures start to grapple with the magnitude of the problems that we are all facing. My name is Howard Fisher, and I'm going to be your guide through this undecipherable tax world relating to disaster. And LaVonne and Alex are going to help decode those issues for you. As Albert Einstein once said, the hardest thing in the world to understand is income taxes. And with that, I'm going to introduce you to LaVonne, who's going to guide you for the next few minutes.
Thank you, Howard. And just kind of a few words about each of us. Howard Fisher is the first Fisher in the Fisher & Fisher law firm. Howard is a business and tax attorney specializing in representing wealthy entrepreneurs and their families. His practice includes tax planning, business and commercial transactions, real estate transactions, business litigation, and tax controversy. Alex Hemmelgarn is a partner with the firm Lewitt, Hackman, where he is a member of the firm's tax and trust and estates groups, and Alex is a certified tax law specialist. I am LaVonne Lawson. I am counsel at the business law firm Leech, Tishman, where I counsel individuals and businesses in a variety of tax matters, and where I handle tax controversy litigation and estate planning. If we have information, we have a number of handouts provided to you. Our contact information is indicated in the respective handouts, and please feel free to reach out to any of us with any questions. And with that, I'm going to get us started on the basics of some of the due date payment and filing due date extensions that have been offered by various agencies, and then we'll move forward from there. Titled Tax Filing and Payment Dates Relief Following a Natural Disaster. So if you could go to page 3, please. And you know, when these tragedies happened, there were announcements that were made both on the federal and the state level. FEMA announced a disaster declaration for the California wildfires on January 8th, 2025, making federal funding available to affected persons in Los Angeles County. And the county matters as will be indicated going forward. The state of California has proclaimed a state of emergency in Los Angeles and Ventura counties. And the question was raised before we move forward as to the ability to change some of these dates, for instance, the federal filing and payment dates, but Internal Revenue Code Section 7508 provides authority to postpone certain deadlines for a reason of a federally declared disaster, and that disaster was announced. Next page, please. The Internal Revenue Service has issued relief. Various agencies have provided their relief, which you can find on their websites. The service submitted or announced Form IR 2025-10. When this tax relief postpones various tax filing and payment deadlines that would have normally occurred between January 7th, 2025 and October 15th, 2025. This is the postponement period, and individuals and businesses that had due dates to file and to pay. Many of these dates have been postponed until October 15th. So for instance, this would cover individual income tax returns and payments that were due on April 15th. This would include contributions to IRAs and HSAs for eligible taxpayers, quarterly estimated income tax payments that were normally due on January 15th, as well as estimated tax payments that will be due on April 15th, June and September 15th. All have been postponed for affected taxpayers, which we'll define going forward. We also quarterly payroll and excise tax returns, calendar year partnership and S corporation returns, calendar year corporation and fiduciary returns and payments, and calendar year tax exempt organization returns, all of which, if they were due during this postponement period, they have been postponed to the deadline of October 15th. That, of course, does not preclude anyone from filing or paying before that. Next slide, please. Penalties for, now here's a distinction, however, with respect to deposits for payroll and excise tax deposits. Those have not been extended to October 15th. Penalties for failing to make payroll and excise tax deposits will not be asserted, or rather they will be abated as long as deposits are made by January 22nd, 2025. So that's a date to remember as well with respect to payroll and excise tax deposits. So how do we determine who's covered? I think by now everyone knows that the covered disaster area is going to be Los Angeles, and particularly the announcement was for Los Angeles County. So the covered area applies to affected persons within the county, and that's a lot of people. So affected taxpayers are individuals with their principal residence located in the covered disaster area, which has been defined, and their spouse are filing jointly. Business entities or sole proprietors with a principal place of business in the area, taxpayers that are not located in the disaster area, but with records necessary to meet necessary requirements during that period. Relief workers and individuals who visited, were killed or injured in the area. And then there may be specific people that the federal government identifies, or that the IRS rather identifies, that could be considered an affected person. This is a little information with respect to information that you can obtain. For instance, we're going to talk a little bit later in the discussion about what do you do when you're missing records, because a lot of people have lost their records. But certainly, at least for basics of transcripts, prior copies of returns, information returns, a lot of that information can be obtained from the agencies themselves. And typically they're not charging people, at least for the most recent information. So you can always obtain free transcripts from IRS. You can order by phone, you can get them online. And there's also ways to request earlier transcripts and to request copies of returns. The IRS will not charge for the most recent return. And then also there's information for contacting the disaster hotline for those people that need to talk to the IRS, as well as for people who reside, affected taxpayers who may reside outside of the affected area and need to let the service know. For people who reside inside of the affected area or business locations filing inside of the area, that information the IRS has. There's also extensions with respect to Section 1031 exchanges, and this is pursuant to Revenue Procedure 2018-58, which has been invoked in prior disasters as well. So for identification periods, as well as exchange periods that fall after the January date, January 7th, then there would be a 120-day extension for those. And now I'm going to, since we're leaving, we're about to go to state agencies, and I wasn't quite sure where I wanted to put this. So I'm going to tee this up now, even though we'll be discussing this a little later, with respect to additional disaster relief. So there was a recent statute that was passed, the Federal Disaster Tax Relief Act. This was passed in December of 2024. And what it does is a number of things. It discusses with payments that are included or not included, but also for purposes of timing, it allows amended tax returns to be filed up to a year after enactment of this act for taxpayers who qualify for wildfire payment tax relief. These amended return provisions are probably more, it allows a year after enactment of the act to file for a refund claim, which extends beyond the typical 3 and 2 year period, or can, depending on the tax year. It may or may not be so useful for purposes of these wildfires that happened in 2025, but certainly for purposes of the timing, it helps require. And it may have relevance in this instance for taxpayers who have to change their position with respect to the 2025 disaster. Moving over to the Franchise Tax Board. The Franchise Tax Board is also using Los Angeles County based upon the disaster declaration for purposes of determining an extension for filing as well. So the franchise tax board has also provided until October 15th to submit a number of returns and payments, including the 2024 individual income tax returns, quarterly estimated tax payments that would fall within that period, January 15th, April, June, September, the calendar year, 2024 partnerships, LLCs, S Corps, and also corporate and fiduciary income tax returns, normally due in April. Next slide, please. So again, who are the affected taxpayers? It will be the same. Taxpayers with principal residence or principal place of business located in Los Angeles County, as well as taxpayers who are located outside. But well, actually, there may be a distinction for taxpayers who are located outside. For taxpayers who are located outside of this area, they may need to call into the FTB to make sure that they get the same relief. But for taxpayers who are outside but have records that are in the affected area, they typically would get the same treatment. Now, one difference with respect to reporting this is for the FTB. The FTB is requesting that people write something at the top of their returns, indicating, for instance, Los Angeles County Fire in blue or black ink to alert them to this in order to avoid getting penalties. They're also, for purposes of when people file electronically, there should be a box that allows people to enter the disaster information. Next slide, please. And records. Again, we'll talk about records later, hopefully, but certainly with respect to records that the FTB has, the FTB does have a number of records available. And they will provide a copy for the most recent tax return free of charge. And if you want to, and you can request prior year returns, those would typically charge $20 per return. And for for the most recent year, one would put the name of the disaster at the top of the request form. As far as the periods that are available, the FTB keeps personal income tax returns and partnership returns for 3.5 years. And then they typically would have corporate exempt organ LLC returns for 5 years. So they have a lot of information, and that is a place to at least start with respect to public information and records. Next slide, please. Penalties. And now interest and penalties are canceled on the underpaid income tax for the length of the extended deadline. And there may be no interest accrual for delayed billings and notices as well. So if taxpayers do have the opportunity to appeal a certain interest accrual and can make that written request if they think that interest should not apply to them during this period. Next slide, please. Moving to the Employment Development Department. So the employers that are directly affected by the disaster may request up to 2-month extension of time from the EDD to file their state payroll reports and deposit state payroll taxes without penalty interest. And that's pretty huge. And that is a distinction, certainly in the treatment of deposits by the service versus the treatment of deposits by the EDD. So the EDD will provide an extension, but this extension, a written request has to be made rather than it applying automatically. So certainly this may be more of an instance for someone, rather than just kind of a blanket treatment with respect to everyone in the affected area, since that the EDD may be looking for an explanation with respect to the disaster and the direct impact on the ability to file and pay the payroll taxes. But a written request for extension can be made, but it must be received within 2 months of the original delinquent date of the payment or the return. Well, so now the distinction between these affected taxpayers, and I'm assuming that this is based upon the state's emergency declaration, affected taxpayers in this instance are going to be those employers who are in Los Angeles County and Ventura County, which also had their fires and had windstorm conditions. So employers in those counties that were directly affected would be the taxpayers to whom this would apply. And then there's some interesting, when you get a chance to take a look, I have here some notes regarding when personal income tax will apply versus unemployment and the ETT and STI. So for instance, for qualified disaster relief payments made by employer, those are not necessarily subject to PIT withholding. or necessarily treated as PIT wages. The sections here on the material, so check those first. But also the definition of disaster relief payments that was defined under the Internal Revenue Code at section 139. And again, there's information here with respect to how disaster relief payments are treated for purposes of other taxes, can be other employment taxes. Next slide, please. Reconstructing payroll records, and the EDD recognizes an employer, there's a good chance that payroll records will have been lost, at least with backups. Hopefully that's a lot less likely currently, but still it happens and this will have happened to a number of people. And that they understand that the employer, it may be necessary to reconstruct records in order to file missing returns. Now, the EDD themselves may have information in their records that may be helpful in terms of prior filings. And they indicate that if the information is not available to determine the exact amounts, employers may make reasonable estimates based on the best information available. And they indicate that they can provide copies of previously filed reports, which may serve as a basis for their estimates. So going to the CTDFA, a California Department of Tax and Fee Administration, which covers a number, numerous programs, aviation tax, cannabis tax, sales and use tax, and more. The CDTFA has provided up to 3 months to file unpaid taxes or fees under their programs. And as with the EDD, again, relying on the state announcement, the affected taxpayers are going to be those in Los Angeles County and Ventura County. And they also can extend deadlines for disruption of service. And they can make relief from penalties and interest available. And again, there's the issue of records. The CDDFA will make records available, such as prior tax returns, audits, information from audits, permit applications. One would think that hopefully there would be the same understanding and allowance for estimated amounts as the EDD, but clearly each agency is acting independently, but is providing relief in some measure. Now, before we get to the Los Angeles County Assessor, just a quick note about the City of Los Angeles. The City of Los Angeles, which if you have a chance later, you can find this at page 26, but it's just a quick note that this city business tax deadline, which is February 28th normally, has been extended to April 14th, 2025. So it's right here. So the City of Los Angeles has provided some relief in that regard. So there is information in this outline with respect to property tax and Los Angeles County Assessor, but I'm going to turn this over to Alex so we can move forward in that discussion.
Good afternoon. As LaVonne said, I'm Alex Hemmelgarn, a tax attorney and shareholder at Lewitt, Hackman in Encino. So much of today's presentation will discuss income tax relief. However, I'm going to focus on property tax. Over the last week or so, property tax has been the issue that I've received the most questions about. Whereas income tax often is a one-time issue, the property tax keeps hitting every single year while you own the property. So it's a special concern. Often the sentiment I've been getting is, well, my home was damaged or destroyed. I shouldn't have to pay the property tax bill that's coming up in April. So today we're going to go through some of the procedures by which property tax can be reduced, or if you have an especially low assessed value of a destroyed home, how that assessed value can be transferred to a newly purchased or rebuilt home. First, understanding property tax disaster relief requires at least a basic understanding of California's property tax regime and its history. And because our audience today, I think, has a varying level of expertise and experience, we're going to start with some basics. Let's start with a little bit of history of how property tax in California works. So our current property tax regime really originates with the passage of Prop 13 in 1978 in response to years of regular increases in property tax rates and frequent property tax value assessments by the California legislature necessary to meet its budget shortfalls. Voters in California approved Prop 13. This proposition amended the California Constitution to cap the property tax rate to 1% of the assessed value and to limit increases in assessed value limited to 2% annually. So since Prop 13, the value of real property is assessed at fair market value on a change of ownership, such as a transfer or a purchase. The fair market value of the real property in the year of that change of ownership or purchase is its base year value. And now we're going to throw some terms around base year value and factored base year value. These are kind of generally used interchangeably with assessed value. So just know when someone throws out assessed value, that's what we're talking about, is either base year value or factored year. I'm going to use the words that are actually in the rules so that you can, when you Google these things, you might be able to find a little more applicable assistance. So each successive year after the initial assessment of the base year value, the assessed value is increased by a statewide consumer price index, which cannot exceed 2% annually. The base year value plus this accumulated appreciation based on the index, that's the factor base year value. Essentially your purchase price plus all these little 2% over the years since you purchased the property. Subsequent ballot propositions in later years has further updated the property tax regime. Prop 58 in 1986 added exemptions for property transfers between parents and children. Prop 60 and 90 added the ability for persons over the age of 55 to transfer their assessed value, their factored base year value, from an existing residence to a replacement residence, and which permitted older homeowners, which allowed them the ability to downsize from large family homes to smaller residences as they age without an increase in property tax. So there was also the transfer of base year assessed value was also extended to persons who are severely and permanently disabled. And the Prop 110, the 60 and 90, that's kind of where we get this idea of being able to transfer assessed value from old homes to new replacement homes. That's where that came from. And we're going to be talking more about that as far as disaster relief. So Prop 19 was approved by voters in the fall of 2020, and it went into effect in early 2021. Now, most of the discussion, I know a lot of us have heard a lot about Prop 19 in the news and online over the last several years. Most of that discussion over the last few years was about Prop 19 severely limiting Prop 58's parent-child exemption. This limitation removed the $1 million assessed value exemption prevented from being reassessed on transfer and limited parent-child transfers to primary residences and only as to the current factor base year value plus $1 million of fair market value. This change actually, I mean, I understand it's complicated, but it had the effect of essentially severely curtailing the parent-child and grandparent-grandchild transfers of real property. And it caused and will continue to cause reassessments of real property as the longtime owners either transfer the properties or pass away. Now, as I said, there are numerous articles online and other CLEs discussing this aspect of Prop 19. It's not really our focus today. We're really focused on the changes that Prop 19 permitted for the transfer of factor base year value to a replacement property. So Prop 19 had two types of these transfers. One was an extension of transfers of base assessed value for persons over 55. Previously, they were allowed one such transfer. Currently, under Prop 19, they're allowed 3 such transfers over the age of 55. But the area that we're really focusing on is the relief for disaster victims, where a homeowner suffers damage to their home by natural disaster or hazardous waste contamination. They are permitted to transfer their base year assessed value from their destroyed home to a replacement property. Where a home is substantially damaged or destroyed by a natural disaster, the factored base year value of that destroyed residence can be transferred to the newly purchased or constructed home. To qualify, the damage must have been sustained by a disaster for which the governor of California proclaimed a state of emergency. We obviously have had that, as LaVonne explained, for the fires. The original primary residence is deemed substantially damaged or destroyed if the land or its improvements, the buildings, sustain damage amounting to more than 50% of the fair market value of either the land or the improvement immediately before the disaster. A replacement residence must either be purchased or rebuilt within 2 years of the date of destruction. Now, this has been a question I've been getting a lot. It's my opinion, and I think opinion of a lot of people in this area, that this 2-year deadline is going to be very difficult, given the widespread damage in Los Angeles County, finite construction resources, busy builders, and backlog bureaucracy. I think rebuilding a destroyed home in Los Angeles County is going to be difficult. And as I'm talking to brokers and builders, maybe impossible. So the form to claim the transfer assessed value, BOE 19V, and we'll have links to all these in the materials, must be filed within 3 years of destruction. So if the replacement home is not purchased or rebuilt within 2 years, or the claim form not filed within 3 years, the new residence will be assessed at its fair market value. Now, missing these deadlines could cause a very substantial increase in property tax over what had previously been paid for that destroyed home. There is a caveat as to the value of the replacement property. And I understand this is complicated. We'll go through it slowly. If the value of the replacement property is less than the fair market value of the destroyed property before the disaster, the original factor base year assessed value covers the new residence. However, if the replacement residence is of a greater fair market value than the destroyed home, the fair market value of the destroyed home will receive its factor base year value up to its fair market value, and the excess will be assessed at fair market value at the time of the new construction or purchase. That's complicated. Let's talk about an example. Okay, so first, we have a property that has a factor base year value of $100,000. We're just going to have these whole numbers for easy math. That's the original purchase price plus all the little 2% that are compounded over the years since the time of purchase. So we're going to presume this person has owned their home for a while. They had a factor base year value of $100,000. The current fair market value when the home was destroyed by a natural disaster is $1 million. They go out and they find a replacement home for $900,000. Because that replacement property has a fair market value of less than the value of the destroyed home, the new home will receive the base assessed value of the previous home of $100,000. That will be the base year value going forward. Now, let's presume those same facts. The same $1 million home when it was destroyed with a factor base year value of $100,000. But now let's presume that the replacement home that's purchased is $1.5 million. Now the replacement home has a fair market value that exceeds the fair market value of the destroyed home. Therefore, the fair market value of the destroyed home, $1 million, takes its factor base year value, $100,000. That takes up the first $1 million of fair market value of the replacement home. Now we add to that the excess fair market value of the new home, $500,000. We add those together, $100,000 plus $500,000. So the new assessed value of the replacement home is $600,000. So if a homeowner recently purchased their home and they had a relatively high assessed value, for instance, say they purchased it in the last several years for $900,000, $950,000, and it's worth $1 million, they're only going to have minimal benefit from this procedure. However, if a homeowner has owned their property for many years and has a very low assessed value relative to their current fair market value before destruction, this transfer of the assessed value can be extremely beneficial, as I'm sure you can see. Okay, so now we're going to move on to, if you can't transfer the base assessed value, let's move on to how we can reduce the tax assessment of real property. This will be valuable, especially if the property isn't a primary residence or if there won't be an attempt to rebuild and use as a primary residence. The first process is an application for a reassessment of property damaged or destroyed, and I quote on the form, by misfortune or calamity. If you use those words like as keywords when you search, you'll find all the documentation. To qualify, a property owner must have suffered damage to their property by a natural disaster, and that loss must exceed $10,000 in current market value. To apply for reassessment of the damaged or destroyed property, the property owner must file Form ADS 820 within 12 months from the date of damage, from the date the damage or destruction occurred. I filed several of these after the Woolsey fire in 2018, and at that time they were processed in, I mean, relatively short order. However, I'm predicting that because of the wide-reaching damage and the experience that we've had over the last several years with the assessors struggling with the parent-child claim since Prop 19 passed, I'm anticipating quite a bit longer wait times for this. This longer anticipated wait times is especially important because payment of property tax is required until the Form ADS 820 has been processed and approved by the assessor's office. So last week, Governor Newsom signed an executive order that directs that taxpayers in certain zip codes, which I have in this slide, can postpone payment of their property tax and business personal property tax statements until April 10th, 2026, without being subject to penalties or interest. Because regular roll property tax payments are normally due in April and December, this extends the payment of the next two regular property tax payment installments. So it should be noted that this postponement relief doesn't apply to payments made through an impound account, and it doesn't apply to any taxes on real property that were already delinquent as of January 6, 2025. If a property owner had property damage and plans to submit a request to reassess property and are not in one of those postponed zip codes, a separate request of a postponed property tax must be prepared and submitted. This form is ADS 820.3. They're found together, 820 and 820.3. It's called Property Tax Installments Deferral Application, and it needs to be filed on or before the delinquency date of the property tax bill installment following the calamity, the fire. Also, all of the forms that we're mentioning here are on the Los Angeles County Assessor's website, so you're able to go there. And I know they have an assessment page, and I think they have a fire relief page that's set, so they should all be together. But if you go to the assessment page and look at forms, you'll be able to find all these forms that we're talking about. There is another procedure to reduce the assessed value of property. If the current market value of real property is less than the assessed value of property as of January 1st of the current year. So let's say that again. If currently the assessed value is less than the assessed value as it was January 1st of the current year, the year in which the damage or destruction occurred, a property owner may file an application for a decline in value review. Now, this procedure isn't solely for disaster damage, and it can be for any reason. This review process actually happens every year. You're able to file for any reason, and the file for a lessening in value of your property. The filing period for the annual decline in value review is between July 2nd and November 30th. Now, my opinion is if the property is damaged in a disaster proclaimed by the governor or president, and the damage is more than $10,000, I think it's probably generally advisable that ADS 820 is probably, I think that ADS 820 procedure is probably preferred, especially if the property owner plans to apply the ADS 820.3 for requesting a postponement of payment. It seems that the ADS 820 claim will be processed as received and doesn't have to wait until the annual review period for the decline in value review. Now, I've used these decline in values reviews before, but that's only been for reduction of value that occurred outside from a disaster, but outside of a declared disaster area. For instance, earlier this year, the situation came up for property damage by landslides, but that wasn't within the proclaimed disaster area in Rancho Palos Verdes. So,
Alex, before you move on from property tax, we have a number of questions in the Q&A that we might go ahead and address.
Let me pull them up and we'll take a look at them.
So I could read them or you could read them. So
Sure.
I assume everyone can see them, but in case they don't. For instance, one person writes, my home is still standing. When it was purchased, it was $570K, and last month comparables at 1.2. Should I assume that I do not want to be reassessed if the value is still higher than, that I would not want to be reassessed since the post-fire value is still going to be above the assessor's current value?
Correct. That's a question that we've seen before. So let's just reiterate that. So the question is if the current value, even after damage, probably is still above your factored base year value, that's going to be a judgment call because you don't want to request a reassessment that raises your tax. So the question is if you are less than half, which you are, whether there's going to be a reconstruction, a rebuilding, or purchase of a new home. But yeah, I would suggest not requesting reassessment and essentially forcing the county to increase your property tax. Howard or LaVonne, do you have anything to add to that?
Just think there's going to be a lot of appraisals, I assume.
Yeah.
With respect to current values and to the extent, how would people address prior values?
Well, that's
Yeah.
going to, I mean, I think the most immediate way is if you had an appraisal for insurance purposes, if it was transferred as part of a probate or trust planning, or if, in the worst case scenario, have an MAI appraiser do a qualified retroactive appraisal. Those are really the ways that I think that the IRS and the FTB or the assessor's office are going to accept.
We have another one regarding property taxes. If a property owner buys a replacement property and qualifies to transfer the assessed value to the new property, what happens to the assessed value of the destroyed property?
Okay, so
continues to own it.
Okay, so let's that's a question that we don't necessarily know the answer to. So we're going to make some presumptions. These things are actively changing. So the question is if you transfer to a new property, a property is destroyed, you choose to buy a new property, you transfer the basis value to the new property, what happens to the old property? So I'm going to apply what happened under Prop 19 when you made a transfer of, well, before that, again, I'm thinking through these things right now. My intuition is that the original property is now going to be reassessed to its fair market value, because that's what's happened in certain situations with Prop 19 when the property has been transferred to a new property, either for a senior or a disabled person. So that's my intuition. It's going to be reassessed at fair market value. And again, these are situations which were faced only rarely in kind of very specialized circumstances that are now going to be addressed by the questions that we're going to have from lots of taxpayers. And so we're going to get some authority on this stuff. So while I'm making a professional guess, essentially, don't take that as first, none of this is legal advice. And second, follow up with your attorney, with your accountant, and keep an eye on the Los Angeles County Assessor's website for updated authority, as I'm sure we're going to get it in the near future. LaVonne, I think
LaVonne, you're muted.
Sorry about that. There are some additional ones here. I know we're going to move over to taxability of payments and losses, but there's some that you probably just contact any of us. But some questions are: would a Prop 19 transfer be allowed for rental property, and would it be preferable to a 1031 exchange? I assume that's going to be a judgment call there.
Prop 19, the Prop 19 transfer applies only to primary residences, so it would not apply. And that's why it said the application for a request to reduce the value, if as we said before, if the damage it will be less than the amount of the base year assessed value, that's going to be your best bet. But no, Prop 19 transfers only apply to primary residences.
Okay. There's more. Maybe we can get to them at the end. Let's go ahead and move on.
Let's keep going.
To taxability of disaster relief payments.
Okay. So now we're going to change gears from property tax to some income tax. Generally, and we're going to move through this part pretty quick. These really are questions that are going to be directed to your accountant. This is a very high level overview. So generally, disaster relief payments are not includable in gross income. Further, the receipt of relief payments because of damage to property or property located in a disaster zone will not increase the tax basis of the property. Again, that's kind of a specialized answer, which I've been getting questions about. However, reimbursements, both from a disaster relief program or from insurance, will limit or eliminate the ability to deduct the disaster-related losses, such as casualty losses, which we'll get into. We're going to discuss more later. So another question I've been getting a lot this week is why I have to pay tax on the proceeds from my fire insurance proceeds. And I know we've had a lot of conversations between the three of us and emails back and forth about this. So, and we'll discuss some of the applicable statutes a little more later. But if proceeds are proceeds of the insurance are for living expenses, then they're not includable in gross income pursuant to Internal Revenue Code 123. And then if insurance proceeds are for damage or destruction of a home, such proceeds are intended to reimburse a policyholder for their loss rather than to generate income. However, if you receive insurance proceeds that exceed the actual cost of the repair or the property replacement, that excess amount may be taxable. And under certain circumstances, which I think are actually beyond the purview of this program, proceeds in excess of basis may also generate income tax. Again, I think these are questions that are very case by case and that should be directed to your accountant. With that, I will now pass off the presentation to Howard.
Thank you. While they put up my slide deck, I want to mention that this is such a convoluted area, the income tax, because some of these provisions don't dovetail nicely, or they have layered definitions.
Also, I'd like to interpose that I think we can probably, Howard and Alex, I imagine we can count on programs going forward on some of these topics alone. So
Yeah, almost certainly.
There's a lot.
I mean, one issue that isn't in my materials is discharge of indebtedness. Normally, if you walk away from a mortgage on your property, if you decide you're going to walk because you didn't have insurance or the insurance is way inadequate, there's a potential for something called forgiveness of indebtedness income. Since you don't have to repay a loan, you may end up having some income. And there's some relief provisions, but it's not clear that the income itself is going to be taxable. These are some of these relief provisions which have been talked about or which we'll talk about. There's a very nice sounding provision, Federal Disaster Relief Tax Act of 2024, that President Biden had signed just about a month ago. Doesn't help an awful lot. The 139 provisions that Alex had talked about has two parts to it. And unfortunately, depending on how you read them, it may only apply to what they call natural hazard mitigation, not necessarily replacement of the property. But it does help bring back the casualty loss, which we'll talk about in a minute, and lowers that from 10% of adjusted gross income to merely $100. And it also shields some of these relief payments from government benefit calculations. So, for example, VA copays, CAL-covered insurance subsidies, and other welfare benefits. Qualified disaster payments, which is what Alex was talking about, is reimbursement for reasonable and necessary personal family living expenses and repair and restitution of the property, the residence, as well as its contents. But there are two parts to 139. The first part, if it comes from federal, state, or local government agencies, those are exempt. The second part, which is what Alex talked about, which is down in G of 139, has a contrary conclusion. We'll leave that for a more detailed program later. Two big concepts that are sort of different sides of the same coin is a casualty loss, which if you do have income, you end up with a deduction potentially, and involuntary conversion, which allows you to postpone the inclusion in income if you go and you rebuild or buy alternative property. And I'm going to go into detail on some of these rules. Casualty loss is a sudden loss such as fire, a looting, theft, and the government's not going to be challenging these in large part because it's going to be pretty easy to prove that there was a casualty. If you're exposed to looting, do file a police report because that'll help. Next slide. The casualty loss is the decrease in value less the adjusted basis. So it's not, I had a $12 million home, it burned to the ground, I have a $12 million loss. To begin with, your dirt hasn't gone away. It may have a lower value because there may be hazardous or toxic substances on the lot. As you may know, you can't clear or scrape your lot right now. You're going to need environmental approvals to do that, even if your house burned down. So, Alex, this is one of those things that's going to be interesting when you start figuring out what the reduced value should be for the land portion of the property. And so some people may be trying to challenge ultimately the land value, saying it's not worth what it once was because of a whole host of limitations. And
if I can jump in, and we have been successful in having property tax appeals after the Woolsey fire for exactly that argument, where the county tries to argue that the land is worth what the land is worth, and we argue because of asbestos damage and having to do abatement that the land is worth significantly less, and we're successful in that.
And Alice, can I assume that you did that with, you had appraisals done, right? So it's really one of the.
Oh, of course.
interesting about the Woolsey fire, there are over 300 applications for rebuilding. Less than half of the homes, and it's now been over 6 years, have been rebuilt. So that doesn't bode well for the statutes like Alex was talking about, where you have 2 years to regain your residence, or for involuntary conversion, it's going to be 4 years. It's going to be very difficult to meet those deadlines. They weren't changed for the Woolsey fire. I don't know if they're going to be changed for the Palisades and the Eaton fires.
Howard, regarding the replace, we have a question about if actually a 5-year period applies.
I see that in the questions too, and I'm trying to look at it. And so the reference is to R&T Code section 70.5, which says that for certain claims that are filed for property destroyed in a governor declared area, it may not be a 2-year, but it'd be a 5-year. So again, that's something that we would need further research into. I do see that code section for the poster that put that in.
Okay, so for these purposes, just follow up with any of us.
And like Howard said a moment ago, I'm sure there's going to be significantly more CLEs and even presentations to the public for these things. So again, we're presenting on these topics with about a week since the disaster occurred, and we're getting, all of us are learning the ins and outs of these very minutia based situations.
If your reimbursement is very substantial and it exceeds your basis, there's always the potential for gain. You would be able to exclude from gain the exclusion from gain on sale of a personal residence, which is $250,000 if you file an individual return, $500,000 if you file a joint return. Here's a simple example. You bought a home back in 1985 for only $200,000. Eventually, you spent $500,000 remodeling it. In 2024, the house is worth $5 million. And here I've just postulated that it was worth $3 million in land and structured $2 million. What's the loss? Well, the economic loss is going to be at least $2 million, but that's not your tax loss. Your tax loss is going to be capped at $700,000, which is your original purchase basis, $200,000, and the $500,000 that you added to the house. And it's going to not be easy to determine the fair market value of the land, because you're going to have to go back to get appraisals, and it's going to be the value of the land versus value of the structure just before the fire, just before the destruction. LaVonne, you want to talk about the safe harbor provisions? Because normally you need a lot of documentation to substantiate your loss. And you want to talk a few minutes about that, LaVonne?
I'm so sorry. I'll get it real quick also about the timing, Howard, and before I get to the safe harbor, and thank you. Just wanted to note that with respect to the casualty loss, it can be claimed on the return for the year of the loss, which would, for these purposes, be 2025. Or it can be claimed on the prior year return, the return that's due to be filed this year, which would be the 2024 return. So people should talk to their return preparer, have discussions with respect to which would work better for them. And for individuals, there's an additional 6 months after the lost year return due date to make the election. And for individuals, that would be October 15, 2026. When you do put requests or make the election, there asking that one put on the return actually information regarding the loss, but the FEMA declaration number. Information on the website indicates declaration 4856-DR, but for that too, I recommend that one check with one's return preparer to confirm which one. And just a quick note, which I guess is obvious, that deduction for individuals for the qualified disaster loss is accepted from the TJCA, which provided that typically theft and casualty losses were not allowed through the 25-year. That obviously would not apply in this instance. So getting to figuring out the amount of the loss, we have information. I don't think we'll have time for that. Talk about that. We can follow up with information regarding ideas about loss records. But just kind of a quick note that IRS FAQs suggest that if records are not available and it's just not feasible to obtain documents sufficient to create normally required records, they will consider document requirements satisfied by best reasonably available information presented in good faith. Who knows what that looks like when it comes to audit or support, but that is the information obviously indicating that one, that estimates may be what one has to use and can be sufficient depending upon the basis of that. But there is also there is a safe harbor with respect to determining the loss as well. And the safe harbors, I'm going to just list them because it's just kind of considering where we are in time, I won't go into them. But there are safe harbor methods, for determining casualty loss. There's a estimated repair cost method, a de minimis method, insurance method, federally declared disaster method called the contractor safe harbor. And you'd be looking for what it would cost to replace the home. And then the federally declared disaster method, disaster loan appraisal, we'd be looking at appraisals. So there are options and there are safe harbors with respect to establishing the loss. And we'll probably have a follow-up program to go into detail with respect to records using the safe harbors and calculating the loss. Howard, turn back to you.
No, me. And although safe harbor is generally not challenged, some of the fundamental factors of the safe harbor, whether you qualify for it, may be reviewed by the government. So you're going to have to do a little bit of work to try and justify the losses that you're claiming. Also, all that we've been talking about for the most part does not relate to trade or business assets. They have very different rules. And if you had a home office and you were deducting the home office on your tax return, that could create some additional issues. Okay, if you end up with taxable income as a result of insurance payments or otherwise, or walking away from the property and you have forgiveness of indebtedness, involuntary conversion would apply. That's when property is destroyed or taken from you, and in effect, you end up getting money. In which case, this is where you have the 4 years, at least under federal law, to either rebuild the property or buy new. So you could go and look for something new. And that may be one of the reasons why a lot of folks are going to have to look elsewhere as opposed to trying to rebuild, because it may not be practical to do it within the 2 or 4 year period. And if you use this provision to exclude the money from that you receive from income, you end up with your old basis plus the cost of rebuilding. It's pretty easy. It's not going to be very difficult to qualify for involuntary conversion. There is something called hazard mitigation program. It's a federal program. And if you end up selling your property, there's special rules on allowing you to be able to postpone your gain. I've not seen it in the Wolseley fire, and I don't know if we're going to see it here. It would have to be rather heavily contaminated property, and I've only seen it usually in the commercial property sense or residential adjacent to commercial. Charitable giving. A lot of people are being very generous and are opening their hearts and their pocketbook and are giving. If you give cash, it's not a problem. You just need a record or receipt a canceled check or credit card receipt is more than enough. If you're giving personal property, it's that you didn't build or make yourself. It's the fair market value of the property. There's some receipt issues. No deduction is allowed for the time that you volunteer or that you give of yourself. And the mileage reimbursement rate, if you end up doing some driving, is a whopping 14 cents. It hasn't been changed since 1998, which is rather unfortunate. If you have pension, profit sharing, IRA, keyhole, and you're below less than 59 and a half years old, you may be able to take withdrawals either for hardship or emergency personal expenses, and that would include for repair of personal residence, and you would not pay the 10% penalty for early withdrawal, and you may be able to average the income over 3 years. So it may be very beneficial to look at your pension as a source of proceeds to help you rebuild. We're not going to go into details on estate and gift, but to many people, the home is their largest asset, and it may need to require some rethinking about financial security of your client now and in the near future, which may require changing some of the estate planning provisions that you have. And it may also create some interesting opportunities if you're very well-to-do, because you'll have diminished value in assets, and you could use that as an opportunity to make gifts.
You know, Howard, before you move on from estate and gifts, someone's asked a question in the Q&A, and it's kind of a flip side from what you were talking about in terms of making deductions. So this person says, what about funds from GoFundMe and direct cash funds, gifts from friends? And if there was a threshold limit, what is that limit for it to become taxable?
Okay.
And
GoFundMe is a gift.
Yes.
So it's simply not subject to income tax.
Right, so I think this person is asking, well, I guess, so for purposes of the donor actually. So you're right, it's gonna be a gift, it's not gonna be taxable, person receives it, and the person that gives it, up to the solution, 19,000.
And the donor, in order to get a deduction, has to give it to a charity. And so, you know, if you have these donation centers and you're bringing goods, you're not going to get a deduction.
But they shouldn't be subject to gift tax up to the exclusion per person.
No, this will be subject to income tax on receipt.
I can jump in too. So I think your question was about gift tax, and so the taxability from an income perspective, as Howard said, it's not taxable for income tax because it's a gift. And as far as gift transfers, it's not taxable until you reach the annual gift exclusion threshold. I think perhaps there also may be one side comment, which is we're talking about U.S. gift tax. If you are a citizen of another country, other countries have very much more onerous gift tax transfer rules, which I'm not going to go into here. If you're a resident, or if you are a citizen or a qualified resident of another country, be very, very careful in either giving or making these types of GoFundMe type gifts.
Good points by both of you.
That's why it's always best to do these through qualified charities, even in your home country. And there's always some very strange rules. For example, I cannot give directly to the Swiss Red Cross because it's a foreign charity and get a deduction. But I could give to the American Red Cross, have them directed to the Swiss Red Cross. So we have these funny rules that have to be paid attention to.
Someone has asked, if you had documentation of a charitable donation burned in a fire, what can you do? What do you recommend?
The charities, if they're large enough, have to give you a receipt, so you go back to the charity.
Okay.
You know, if it was goods that you dropped in a Goodwill bin, you know, it's going to be nominal anyway. And so the bigger donations, there'll be lots of third-party documentation, you know, qualified appraisals and things of that nature.
Give their CEO a call. They're more than happy to probably provide a replacement receipt. That's my suggestion.
Sure.
Good idea.
If you're waiting for a change in the deductibility of state and local tax, don't hold your breath. There's been no discussion other than some of the people in Congress from California, New York, and New Jersey asking for it. Secretary of Treasury doesn't seem to, the Scott Bassett, who's the nominee, doesn't seem to support it. And he shows full support for the Jobs Act. which is likely to get through the reconciliation process. And the thought is maybe by Memorial Day, we're going to have that back in place. The Commissioner of Internal Revenue Services resigned, Billy Long, and the person who's slated to replace him, former congressman, doesn't have a big tax background and has shown no inclination to change the SALT area. I can see some changes possibly for disaster relief, especially dealing with if people are going to have to walk away from their homes. You may see some of that, and you may see some change and make it clear that insurance payments and proceeds in excess of basis don't generate any sort of taxable income. But outside of that, don't look for any big relief in the immediate future from Congress. And with that, let's, LaVonne, go on to questions.
Sure, and
Sorry, this is just a list of some IRS publications, including the form that LaVonne had mentioned, the 4684. The Casualty and Disaster Theft book, which is the first one, is pretty good. It's fairly extensive. So there's a lot of good resources. Alex mentioned the assessor's webpage. He's been right on top of this, doing lots of emails and lots of communications. So a lot of good information is available.
For 401k distribution, will it only be affected for affected taxpayers or the entire county of Los Angeles? I would think, I'll ask you both. I would think that for affected taxpayers are taxpayers in the county of Los Angeles.
Well, it's a hardship or a disaster, so you have to take it out for a qualified purpose. So
That's
it's kind of a two-step.
Show the proof, they'd have to prove
I
it.
lived in Palisades, and the fire burned to the left of me and the right of me, and my house is standing, and I want to use the money to buy a yacht. Not going to work.
Right, so if they're simply asking if they can do that for anything, no. But if they are a taxpayer in the county of Los Angeles,
no,
and they have that loss, then that's an option for them.
And for any types of distributions, you would always want to have a statement of facts, even if you didn't have to have one. Best practices is that you always would have a statement of facts for the reasons you're doing this, because that's the way you do these things.
By the way, the special rules for pension and profit sharing, these are general rules that have nothing to do with disaster. So you don't need a federal disaster claim. It could be my one house burned, period. So
There's this may have been answered, but I'm not sure. What is the relationship between reduction of property tax assessments and the ADS 820 and the Prop 19 transfer of assessed value to purchase a new house on destruction of the old residence? I think that I know you went over both, but maybe you want to point out that distinction.
Sure. So the Prop 19 transfer is for primary residences where you're going to either rebuild the property or transfer it to a newly purchased property. And so if you're doing that, you're trying to maintain your low assessed value. So then the ADS 820 procedure is if you're trying to reduce your assessed value for property that was damaged. Generally, there are different procedures for different problems. They're not going to apply for the same problem. One is for replacing where you want to maintain, often for a long time owned primary residence where you have an extremely low assessed value. And then the other is for any property where you're trying to reduce the assessed value, more often used for newer properties, and it's available to be used for not just primary residences. And
someone's asking if we're going to review section 1033, other than having noted the extension. Oh no, 1030. I'm sorry, that's involved. How would the involuntary conversion? I think that Howard touched upon that.
Yep, we
We'll
did.
probably end up with a separate program on that to go into that in detail.
And then I see the top question is the 2% Prop 13 increase compounded, which isn't exactly for disasters. Yeah, it's always compounded. You can see that either on your tax bill history on the LA County Assessor website, or by Googling, and often Zillow or Redfin have the property tax history where you can see the compounding appreciation.
The assessor has something called a portal, assessor's portal, and that has detailed information on the property tax for each parcel.
If someone's asking about personal property, would it also be deductible? Well, it could be the subject of a casualty loss if they can establish the value of property. And I don't know, does other of you see any other questions that you think that you did not touch upon? Well,
I see one. I
like-
see one, which is a question about what do you have to apply for the postponement of property tax if you're in the zip codes mentioned? No. So if you're in those zip codes, no action or application is necessary. Property tax is going to be postponed. If you're not in those zip codes, then you would have to file the 820.3 form.
so someone's simply asking, how do we know what the current fair market value of our home is? And, you know, they may not be able to access it now, but for these purposes, Alex, I assume they're gonna have to, everyone's gonna be hiring an appraiser.
Yeah. For most of these, especially if you're trying to have an appeal with the assessor afterwards to establish the value, the best way to do it, as I said, is going to have a qualified appraisal, generally from an MAI certified appraiser. That's what we normally recommend.
Excellent.
And there are special rules when you talk about appraisals for real property purposes for the assessor versus for the IRS.
But generally, my thought is you're going to be using these appraisals for more than one purpose, and if there's not that much difference in the cost, generally having the qualified appraisal, which is going to be best for all the purposes, whether income tax, property tax, or otherwise.
And while you're looking through to see if there are any more questions that you think are unaddressed, I'd like to kind of just touch upon topics of records briefly. Just that we've discussed how people can obtain tax records, prior returns, possibly audit information, other information provided to the agencies. They will have that, and we can obtain copies of that information going years back, but only so far back. There's also other suggestions, for instance, regarding real property. Take photographs or videos as soon as possible. Contact the title company, escrow company, or bank that handled the purchase of the home to get copies of documents. Use the current property tax statement for land versus building ratios if available. If not, you can get it from the county assessor's office. Establish a basis or fair market value of the home by reviewing comparable sales. Obviously, that's not going to work necessarily here. I guess if you have the current values, it's not going to work. For prior values, if there were sales anytime before, that's going to be helpful. Check with the mortgage company for copies of appraisals or other information. Review insurance policies as they usually list the value of the building, establishing a base figure for replacement value insurance. If improvements are made to the house, contact contractors who did the work. Written accounts from friends and relatives. See if any of them have photos, if there were any get-togethers. If there's a home improvement loan, there may be paperwork that was established for that. Check court records for public values with respect to inherited property. Maybe the trust and estate lawyer has information. And if no other records are available, check the county assessor's office for old records that might address value. With respect to vehicles, you can look at Kelly's Blue Book, the National Automobile Dealer Association, Edmunds, and then obviously personal property is going to be very difficult. With respect to, it may be possible, they may be open to even looking at drawings and descriptions if one doesn't have pictures. Obviously, recreation of records is going to be one of the most difficult things in terms of trying to establish values in certain pieces of property. But again, as indicated, the agencies, what sounds are willing to be flexible and consider reasonable information in times like this when there's not other supporting documents. And Alex and Howard, were there any other questions that you thought that you saw here?
I think we've touched
I was
on.
asking about information returns, and frankly, I was talking about this with Howard because I was like, I wasn't quite sure. I thought it was a little bit silent. Forms 1099 and 1096 still need to be filed by the end of January and February. They're not specifically listed. They are returns that are due, but they're information returns, but they're returns that are due during the pay period. I will try to get more information about that if someone wants to contact me, but I wanted to get your thoughts, Howard, now.
It doesn't make a lot of sense, but on the other hand, there are people that are going to be filing on time. And most people who file 1099s file them electronically. They're big payers, they're mass payers. So it's not going to be a problem for them. And I guess that's what the thinking was, maybe why we haven't seen it. Same thing for 1065s, partnership returns. They tend to be businesses, and most of the losses here were not, businesses.
Good point.
So I'm going to probably try and get my 1099s out in time.
And for most of these filings too, that even if they weren't filed, if there was impossibility, there's reasonable cause abatements for most penalties too. So that's not the best way to go, but it's always the good kind of catch-all, which is if you had destruction of records in the fire, you have a pretty good reasonable cause claim for abatement.
Very good point. Well, I imagine that there will be another program soon touching on some of these, getting more, deeper into voluntary conversion, casualty loss, and a number of other topics that came up. But I didn't know if anyone had any kind of final parting comments before we go.
My heart goes out to everybody who has suffered a loss and everybody who knows somebody who's suffered a loss. And for everybody who's had a loss, there's going to be 2 or 3 or 4 people who were associated with them in some way who are going to be adversely impacted by this tragedy. And it's going to be a long time for all of us to recover. So patience and keep good thoughts.
And
Alex?
if I or anybody in our firm, or I'm sure I speak for all of us, our contact information are in the materials. If there's a question or way we can be of service, feel free to give us a call, shoot an email, something like that.
And I mirror Howard's statements. Howard, thank you for speaking for all of us, and thank you everyone for joining us in this discussion. Again, if any questions or if there's anything that any of us can do, please do not hesitate to reach out.
Bye.
With that, I guess we're done. Thank you.
Thank you.
This program and the associated written materials are provided for informational purposes only and are not intended and must not be taken as legal advice on any particular set of facts or circumstances. You should not act or refrain from acting on the basis of any content included in this program without seeking legal or other professional advice on your specific matter. This program contains general information and may not reflect current legal developments or address your specific situation. This program and the associated written materials are not intended as a solicitation.